I want to tell you something that most people in markets never fully internalize, even after decades of experience. The periods that feel the worst, the slow grinds, the sideways action, the weeks where nothing seems to be happening, and the narrative around an asset turns from excitement to indifference. Those are not the periods to fear. Those are the periods to pay attention to. Because what markets do during consolidation is not nothing. They are building the structural foundation for what comes next. And what comes next in a genuine secular bull market is almost always larger than what came before. Gold and silver are boring right now. I want to be direct about that rather than dress it up. The price action is slow, the moves are grinding, and this correction is likely to continue for another month or two before it fully resolves. If you came into this video looking for a reason to get excited about next week, I am not going to give you one. The short-term picture is uninspiring by design. But if you came here to understand where we are in the larger cycle, what this correction means structurally, what history tells us about what follows these periods, and why the investors who have done the serious work are using this time to prepare rather than retreat, then stay with me. Because the case for what is building here is one of the strongest I have encountered in my years of studying these markets. Boring is not the enemy. Boring is the setup. Let me start with the structural reality, because everything else in this video rests on it. Gold has experienced a significant correction from its recent highs. The magnitude of that correction, approaching 27% from peak to the recent intraday low, is not a small number. For investors who have been watching that drawdown accumulate, the discomfort is real, and I understand it. But I want to place that number in its proper context, because context is what separates informed decision-making from reactive decision-making. There have been 3 major breakouts in gold in the modern era. Not 10, not 7, 3. Each of those breakouts was followed by a correction before the next large advance began. When I examine those corrections on the same scale, the same time axis, the same percentage parameters, the current drawdown is not anomalous. It is consistent with the historical template. In one prior instance, the correction following a major breakout reached 28% before the next major advance began. That advance ultimately carried gold substantially higher over the following 18 months. Here is the number I want you to hold. If you take the framework suggested by those prior breakout analogs and apply it to where gold is today, the implied trajectory over the next 18 months points toward levels that would represent a transformational move from current prices. I am not going to anchor you to a specific number and ask you to treat it as a forecast. What I will say is that the historical structure of what follows these corrections, once they complete and once the larger bull market reasserts, has consistently been substantial, not modest. The correction does not change that structure. It is part of it. Before we get into the specific price levels and timing, I want to make a distinction that I believe is the most important conceptual framework for anyone holding precious metals right now. There are different kinds of peaks in a bull market. There are intermediate-term peaks, corrections within the larger uptrend that shake out weak holders and reset sentiment before the next advance. There are cyclical peaks, the major highs that mark the end of a multi-year bull phase and are followed by extended corrections measured in years. And there are secular peaks, generational turning points where an asset moves from undervalued to overvalued on a multi-decade basis. The confusion between these types of peaks is responsible for an enormous amount of wealth destruction in markets. Investors who mistake an intermediate correction for a cyclical peak sell at exactly the wrong time. Investors who mistake a cyclical peak for a secular one hold through an extended decline that significantly impairs their returns. Getting these distinctions right is not academic, it is practical, and it is financially consequential. Where are we now? Every framework I apply points to the same conclusion. We are in an intermediate-term correction within a larger cyclical bull market that has not come close to reaching its peak. The ratio of gold to major equity indices, one of the most reliable indicators I track for assessing where we are in gold's larger cycle, shows the pattern of intermediate peaks and recoveries, not the vertical outperformance that has historically preceded cyclical peaks. We are not at a cyclical peak. We are recovering from an intermediate one. Understanding that distinction is what allows serious investors to treat the current environment as an accumulation opportunity rather than a warning signal. The boring phase we are in is not the prelude to a secular decline. It is the pause before the next intermediate advance, the one that, in the historical template, carries prices significantly higher than where they peaked before the correction began. I want to be specific about timing because vague bullishness without a framework for when is not useful. When I map the current correction against the corrections that followed the other major gold breakouts, on the same scale of time and price, a consistent pattern emerges. These corrections are not primarily a price story, they are a time story. The price damage in the current case has been substantial but is largely behind us. What the historical analog tells me is that the remaining work is temporal, that the market needs more time to consolidate, to re-establish equilibrium, to allow the sentiment and positioning that built up during the prior advance to fully unwind. My read of the historical template points to approximately 2 more months of this correction before a durable bottom forms. I want to be clear about what I mean by that. I am not saying price cannot move lower. It may, and there are specific levels I will address shortly where I would expect buying to emerge. What I am saying is that even if price finds support relatively soon, the full resolution of this correction, the point where the market is genuinely positioned for the next leg higher, is more likely to be measured in weeks and months than in days. This is why I keep returning to the concept of boring. The market does not need a dramatic crash to complete this correction. It needs time. It needs the slow grind of consolidation that wears out the impatient holders and allows the patient ones to accumulate at favorable prices. That process takes time, and the investors who understand that are not frustrated by the slow action. They are using it. One additional point from the historical analog that I think is worth stating explicitly: the performance following the completion of these corrections has been significant. The investors who held through the boring phase and added to positions at the lows were the ones who captured the full magnitude of what followed. That outcome is not guaranteed to repeat with identical precision, but the structure that produced it is present. Let me move from the conceptual to the specific because levels matter for practical decision-making. For gold, the weekly chart shows 2 levels that I have been watching closely. On the resistance side, there is a clear level around $4,525, a price that gold tested multiple times in recent weeks without being able to establish a clean weekly close above it. That resistance is real, and it is likely to contain any near-term rallies before the correction fully completes. On the support side, the $4,200 to $4,250 zone stands out clearly. Multiple weekly candle tails have touched this level. It represents the kind of technical support that is built over time through repeated testing, and it aligns with where the longer-term moving average is rising to provide additional foundation. Below the current price, this is the level I am focused on. I want to reiterate something I said previously because it becomes relevant at this support level. If gold falls below its 200-day moving average, that is not a sell signal. In both prior comparable corrections, gold briefly violated its 200-day moving average before bottoming and beginning the next major advance. A break below that level, when it comes, should be read as a signal that the correction is in its final phase, not as confirmation that something structural has broken. For silver, the current picture centers on the $66 level as the key near-term reference point. Silver has not produced a weekly closing break below $66. That matters. A weekly close, not an intraday move. A sustained close below that level would suggest additional selling toward the lower support zone in the $55 to $60 range. That lower zone, anchored by where silver paused during its original breakout and reinforced by the rising 200-day moving average, represents what I believe is rock-solid structural support. The most constructive short-term scenario for silver would be a move toward that $66 area or slightly below, followed by a bullish reversal candle, a hammer pattern where price makes a tail below support, but closes back above it by the end of the week. That pattern, in the right context, is one of the most reliable signals I track for identifying short-term exhaustion of selling pressure. I am watching for it. The underperformance of gold and silver relative to equities over the past several months has a specific cause, and I think it is worth understanding clearly rather than treating as a mystery. When I look at the ratio of gold to major equity indices, I see a chart that tells a coherent story. Gold outperformed equities dramatically in 2025 and into early 2026, a period of significant vertical outperformance that, in hindsight, was unsustainable in the short term. That kind of extreme outperformance always resolves through either a correction in gold or a recovery in equities. We have seen both simultaneously. Equities have rebounded. The stock market has made new all-time highs. Expectations for corporate earnings in the near term are constructive, and money has rotated back out of precious metals and into equities, particularly into the technology-heavy segments of the market that drive capital flow dynamics most significantly. What is the structural implication of this rotation? The gold to equities ratio has retreated toward a key breakout level, a level that represented 13 years of resistance before being broken. The ratio is retesting that breakout. This is entirely normal technical behavior. Breakout levels convert to support, and the retest of that level is what establishes its validity as support before the next advance. What does this mean for timing? In the near term, 1 to 2 months, the capital flow dynamic continues to work against precious metals as the equity rally absorbs attention and capital. In the medium to longer term, 4 to 12 to 18 months, the structural case for capital rotating back into real assets and away from equities is one of the strongest I have seen in years. When that rotation resumes, it will not be subtle. The mining stocks add another layer to this picture. The ratio of gold equities to gold bullion has been in a multi-year base, a 13-year consolidation. That base has not broken out yet. But the structure is present, and when it does break, when gold stocks begin to sustainably outperform the metal itself, it will signal a phase of the bull market where the leverage that mining equities provide relative to the metal becomes the dominant source of returns. I watch this ratio weekly. The setup is not there yet, but it is building. The breadth data for the mining sector is telling me something specific, and I want to share it directly. I track indicators that measure participation across the sector, specifically what percentage of mining stocks are trading above their key moving averages. The logic is straightforward. At meaningful bottoms, broad selling has pushed most stocks below those averages. At the exhaustion of that selling, you get a concentration of oversold conditions that historically precedes strong rebounds. Where are those indicators now? The percentage of mining stocks above their 200-day moving average is still elevated relative to where it has been at prior correction bottoms, currently around 82%. For a correction of this magnitude to fully complete, I would expect that number to compress substantially toward 20% or below, accompanied by near-zero readings on the shorter-term 50-day and 20-day measures simultaneously. We are not there. Which brings me back to the time point I have been making throughout this video. The correction needs more time. The internal damage that historically precedes a durable bottom has not yet fully manifested, but the direction of those indicators is clear. They are moving toward the zone that has historically marked buying opportunities. We are in the process of getting there. When those readings converge, when the percentage above the 200-day compresses toward the low end, when the shorter-term measures approach zero, when the price action produces the reversal signals I described, that combination represents one of the most favorable entry conditions in this market. I have seen it before. I know what it produces. The setup is currently in process. The recent short-term bounce in mining stocks is real but requires context. Over the last several sessions, the miners have shown some buying, bullish hammer candles, long tails on weakness, some evidence that selling pressure is being absorbed. This is encouraging from a sentiment perspective. It suggests that acute selling exhaustion is present at current levels. But I want to be honest about what this bounce represents within the larger picture. The miners remain below meaningful resistance levels. The candles that preceded this bounce, sessions where price opened near the highs and closed near the lows, signaling distribution, told a story of selling into strength that is not yet fully resolved. A short-term bounce does not erase that signal. My read is that this bounce may extend for a session or two, possibly into next week, before the correction resumes its work. The 200-day moving averages for the major mining indices are rising and will provide support as price moves toward them. But the final low of this correction is more likely to occur after additional time and price work than to have already been established at current levels. The correct posture, in my view, is patience, not anxiety, not urgency to add aggressively at current levels. Patience, watching for the breadth signals, watching for the price structure, waiting for the conditions that historically mark the transition from correction to the next advance. Those conditions are approaching. They are not yet fully present. Let me close with the principle that has been at the center of every observation I have made in this video. In a secular bull market, the boring phases are not obstacles. They are the mechanism, the consolidation, the slow grind, the weeks where price moves sideways and the narrative shifts from excitement to indifference. All of that is the market doing the work that prepares for the next major move. The investors who understand that work with the process rather than against it, they accumulate. They are patient. They watch the indicators, monitor the levels, and position themselves for what the structure is telling them is coming. The structure here is telling me that approximately 2 more months of this correction likely remain. That price damage in silver is largely behind us, while time is the remaining variable. That the internal indicators are moving toward the conditions that have historically marked buying opportunities. That the capital flow dynamics that are currently creating headwinds for precious metals are temporary expressions of a rotation that in the medium term reverses in favor of real assets. None of that means next week will be easy. It probably will not be. But the investors who are focused on next week are looking at the wrong time horizon. The investors who understand where we are in the cycle, who are using this boring phase to prepare and accumulate, who have the patience to let the market complete its work, those are the investors who will capture what the historical structure says comes next. I want to hear from you in the comments. What are you watching most closely right now in this correction? What would change your assessment? These conversations make the analysis better, and I read them. And if you want to go deeper on the structural case for where gold is headed over the next 18 months, I have a video that addresses exactly that framework. I will link it at the end. Thank you for watching. Peace.